So the Dow Jones Industrial Average hit 30,000 yesterday, November 24th, 2020. Today, the S&P 500 hit 3,604.01, which is a 7% increase on the pre-COVID February 19th, 2020 number. Why? Is the market too high? Arguably, yes. In today's video, we go over the math on the valuations and to really make sense of what's going on in the market and the economy today. So with COVID-19 running rampant all over the globe, especially here in the US with over 200,000 cases a day, you can wonder what's going on. Why is the market hitting all-time highs? The S&P is up, the Dow Jones is up, the Nasdaq is up. What is going on? Well, to make things kind of even more confusing, it's narratives. And if you do need time or you do need to sleep, I recommend an audiobook called Narrative Economics from Robert Shiller, whose work I do quote in today's video. You can go check out the link down below to get that audiobook at no cost. And again, if you're a total nerd like me, or if you need help going to sleep, you can go ahead and listen to that. It's very, very good, especially now because of COVID-19 and how narratives, just like viruses, spread and their correlation being why they spread and how. And it goes through all the historical fun times like the Spanish flu, the Great Depression, and how the narratives actually kind of shaped our view historically on what happened and even during the time it happened. So you can see the link below and get that audiobook on me. Now, COVID-19 narratives. Let's go first and actually not use the Dow Jones because that's only 30 companies. I like data. The more data you have, most times it's a little bit better prediction. So the S&P 500, which follows currently 505 companies, that's what we're going to use in today's analysis. And let's figure out how the market has reacted to COVID-19 and follow things like the earnings to get a valuation. And let's break down on how we get a valuation. With the S&P 500, we'll get a better idea on how the US markets reacted to COVID-19. And to figure out if it's mathematically overvalued, we need to find some kind of a valuation method. First, we'll look at earnings per share. Next, earnings growth, earnings guidance, then onto valuation and the PE ratio, and of course the forward PE ratio. Then after we look at those things and what's going on around those numbers, we'll go into a little bit more on why I think that it's not a true valuation of what the stock market is doing and why most investors actually agree with that statement, and potentially how you should evaluate your portfolio. So let's go back to pre-COVID and figure out where we are in relation to what would happen, because what a lot of economists and analysts do is they say, well, what if we took out the entire COVID-19 and then went with what it would normally do if COVID-19 didn't happen? What would the normal stock market look like? Well, like I said in the beginning of the video, the pre-COVID number to now is about a 7% increase over 9 months. So that's not so bad considering that, well, the US stock market's supposed to be growing at a rate anywhere between 10 to 12%. So we're, if anything, just a little bit lagging our year-to-date for 2020 anyway, ex-COVID number. And if we took a look at First Trust, who has the famed Brian Wesbury as their chief economist, they predicted that the S&P would end the year 2020 remaining bullish at 3650, which is just a little bit above what our current November 25th number is. So guys, I know there's a lot to this video. It's going to go longer where I go into how the phase of COVID affected the market, and then also how the PE ratios and all the valuation tools we use to quantitatively evaluate something isn't really working. And because all the averages are moving forward and we have current data which is not moving forward, it's present, a lot of the valuations look pretty poor. As you just saw with this thing on the screen here, that the S&P 500 target for December 31st, 2020 is actually not more than about 0.1% away. We're really close to where we were predicted to be. Now, the stock market is a forward-looking right? It's earning per shares, future value of putting your money in the market, and expecting a return at a later, and in this case, a much later date. So that's why it's so, I guess, overpriced in the eyes of many value investors or people who follow the metrics. I am someone who likes to follow the metrics as well, but as you can tell if you watch further into this video, the narratives is really what drives the market. So if you just wanted to find out if the market is too expensive right now, yes it is, but why it's expensive and why it's going to just keep getting more expensive is kind of more the theme of 2020. And if you go ahead and look and watch the rest of this video as I go toward, COVID and also the two main narratives that I feel are driving the market, you'll get a better idea. But this video is almost 20 minutes long by now, so I just wanted to just cut in before I wrapped or before we got too far into the weeds and too far into my theories, and give you that as the P/E ratio, earnings per shares, future earning per shares, all of these Shiller ratios, everything like that, they tell us a snapshot of a story in the future to guide us when we are interpreting these narratives. So there you have it. Sorry I couldn't be clear. If you watch to the end of the video, you'll hear me say nothing's ever clear cut. The market is the market and we just got to deal with what we got. It's all empirical data. This is not physics. This is not set science. I wish it was, but it's not. And it makes my life both interesting and challenging at the same time. I'll get back to the video. For this analysis, I'm going to use the Shiller ratio, which pretty much is a smoothed out PE ratio over 10 years, which takes the earnings, inflation adjusted, and then compares it to the price of the index. So the CAPE ratio historically was 17.1 as of November. The mean is 16.76. The median is 15.18. The minimum back in December 1920 was 4.78, and the maximum about 20 years ago in December 1999 was 44.19. So where are we today? According to the Shiller ratio, today we're actually at 33.18, which is far above the average, almost double the historical average, and we're just below that December 1999 high. It's about 11 points to kind of compare. So what does that even mean for valuation wise? Is it the time to sell? Is it overvalued? Should I even start investing today? Well, there's this nifty graph I have here on the screen. It basically tells you that the PE ratio versus the actual price of the index has been severely non-correlational in the past and isn't really a good indicator, even though it is technically an indicator for price and for valuation. What is wrong? What's going on? Well, it begins with narratives, and there's a multitude of narratives out there, but today I'm going to go over basically just two of them, which I feel have a high amount of weight to why the index is so high and why people are saying that the stock market is so overvalued. Well, the first thing is investors believe that earnings will pick up. Earnings report were sent out with surprising results, which means that the economists and investment experts, their guidance was severely underestimated. So when they made estimates for quarter 2 and quarter 3 and quarter 4 as far as what they felt like the companies could hit, they were severely pessimistic. They thought the companies weren't going to make any money and that they weren't going to do well at all. So what happens? The market prices that in. And today, because the earnings were so much better than they had predicted, the market's going to get optimistic. Now, to solidify this confidence, take a look here at the estimated forward PE ratio. The current forward PE ratio for December is 39.28, and by December 2021, experts predict it to be closer to 24.19. This is public data. So by the end of 2021, investors believe that the S&P 500 will be properly priced if you bought it today, taking into consideration December 2021's 24.19 PE ratio. Which leads me to my second point on the earnings portion, is that if earnings increase and the price stays relatively the same, the PE ratio will decrease. So is that Shiller ratio, that 33.1, is that overvalued today? Well, of course it is, because the earnings are so deflated due to what's happening in the economy. In all the lockdowns, companies are making far less money than they were before. Airline industries aren't making pretty much any. They're just focusing on stopping the bleed. And again, all of this data, which is public information, has already been priced into the S&P's number. And I'm not going to go into it in this video, but market efficiency is something that most investors believe before going in to buying any kind of investment. And that basically, to sum it up, says that the market will always be efficient because everybody has the same data, everybody has the same predictions, everybody can run through the same models. So if the price is what it is today, it is because everyone agrees that it should be around this much. So the second narrative that's going around is that the federal government and the Fed is doing everything they can to try and keep the market from falling. So they'll have stimulus checks, they'll have stimulus packages, they'll help businesses recover. The Fed, with their zero interest loans, or the prime rate staying so low, pretty much encourages people to start again. So business-wise, that is what is driving a lot of this price uptick. Another thing to consider, and I don't really have this on my notes today, but consider that all of these, the S&P 500 is really only 500 of the companies, or 505 companies to be exact. And many of these companies are not, or are doing relatively well because of their relative size. Also, certain industries in the S&P, like the hospitality industry, the travel industry, have taken such a huge hit that the only reason the market's still up is because the S&P includes people like Microsoft, Apple, people who have, or companies who have large earnings even through this time. So it's not really a investment strategy, it's more of a reflection on how the US economy is doing. So if the US economy's earnings are predicted to be higher than expected, even with what's going on with the coronavirus, then the market is more of a true reflection on what the US economy is going to be moving forward. And that's pretty much, to sum it up, what the S&P 500 is meant to do anyway. So basically, don't look at the data for valuations. You have to take into consideration narratives that are going around, especially in the market where the data is empirical. So it's not like a science like physics. We can't depend on one particular ratio or one particular report to give us the whole story that's going to definitively happen. And lastly, my recommendation to you guys is to always review your goals and your risk tolerance, because those are going to guide your investment choices. Most times, people who are investing, especially on this channel, for the future, long term, things like this are mainly just a cautionary tale to people to always stay invested long term if that's your goal. As you can see on this chart here, the S&P 500 historical return results, what this kind of gives us is a snapshot of the S&P 500 adjusted for inflation with the dividends you're invested. We find that over these investment periods, 40 years, 30 years, 20 years, 10, 5, and 1, the average return rates, the median, maximum, minimum, and the standard deviation. So as you can see, as a 40-year investment period, this is not from 1960 to 2000 or 1980 to 2020. This is basically all the different kinds of periods. 40 years, sequentially, they calculate the average return is 6.494. The maximum return is 10.28. Minimum return is 3.187. Now we go all the way back down to 1 year. You have a higher average return, a much higher maximum return, much lower minimum return, and a higher standard deviation. So as you can see, as you invest longer, you're going to have potentially less returns, but a much more stable overall return. And let's go a little bit lower. You can see the percentage beating annual return over periods. So if you have a 40-year length of investment, you have a 90% chance of getting at least 4.906. All the way down here, 40 years, you have a 10% chance of beating 8.25%. So for long-term investors, for retirement planning investing, this is kind of your chart to look at. So if you got 40 years left, you can expect these kinds of returns if you use the US growth as your investment strategy. If you have 10 years left, here we go here. If you're only investing 1 year out, this is where more of your, speculative investing comes in, where you're not really investing for the long term, you're more investing for, quick gain. As you can see here, maximum 150%. And on the, low risk side, or high risk side, you have a negative 58%. So you're working with quite a spread there and quite some risk, right? High risk, high reward. We go down here, very low risk, not so bad reward, 10%, but that's where the kind of methodology comes in for us long-term investors. Quick tip: one way to see how any particular investment is going to perform during a crisis is to actually look at how it performed in other crises. And how would you do that? Well, you look to things, metrics like this. Number 1, the max drawdown. Number 2, the max drawdown begin and end date, the max drawdown length, and the max drawdown recovery date. For example, you see how long it took to break even and how far it went down. Another key performance metric that I like to look at is what's called the upside capture, downside capture, and then lastly the beta, which basically tells us how much of a crazy ride we're going to go through by investing in this particular investment. So my 2 final thoughts on, is the market too high? Well, I would just like to remind you folks that again, the S&P 500 is not an investment strategy or retirement strategy. It is merely a guide or a reflection on the US market. And secondly, always keep in mind or pay attention to your risk tolerance and investment horizon. If you need something to be invested today to make you money tomorrow, you should just go to work. If you want something that's going to invest today and give you great chance for growth in the future, 10, 20, 30, 40 years, remember that chart that I just showed you, that one will give you a good gauge to what you can expect to return or expect as return in the S&P 500. So it just gives you a good gauge on the US market and how those markets have performed over a long period of time. Well, I hope that helps you guys today understand the math of the markets. Not so straightforward, never so clear cut, and I'll see you in the next video.